So good evening, everybody. Good afternoon. What a beautiful day, huh? Great. I'm Dave Sullivan, a shareholder, Director of Business Development at Perkins and Company, the accounting firm here in the building, and we're delighted that you're here. However, I want to make sure you're in the right space. It occurred to me that one of the things that some of these meetings end up being multi-level marketing deals, like household detergent. Anybody here for that? No? How about timeshare with swampland in Florida? No? Okay, what about the federal tax code? Hey, that's exciting, right? Okay, sorry, colleagues. No, we're delighted to have you here. I'm going to do a show of hands. So thinking about the federal tax code, who thinks that you're going to end up being a winner? Raise your hand with what you know. Okay, all right. Who thinks you might end up being a loser, as in financially speaking? Show of hands. Okay, all right. Yep. And who's not sure? Yeah. Okay, that's why we're here, because we're not sure. And the bottom line is, some of the smartest CPAs in the country are not exactly sure about what all this means, because as you guys know, this federal tax code was finished up over past midnight, and there were lots of scribbles in the margins. And so if you hear...
They told us it was tax simplification.
What? It wasn't? I know. Don't believe it's fake news, Pat.
Okay.
But no, truthfully, as you guys know, this is very, very complicated stuff, and we're going to try to make sense of it over the next 90 minutes, and we really want this to be an interactive discussion. So we'll have a presentation, and we're going to cover everything from implications for corporations to owners to individuals, and also look at implications for estate and tax and consider the planning options there. But we really want this to be an open discussion, and so feel free to raise your hands during the process if you just want to have burning questions, so we can make sure everybody kind of gets a handle before we move on. We do have a ton to cover, so we'll keep it moving. My friends behind me will stay around afterwards, and I know that there are some CPAs here from Perkins. If you're a CPA from Perkins, don't be shy. Raise your hands. Okay, thank you, Trina. Got Jennifer. Chris, the head of our tax department, is not raising his hands. He's in the back row. Look back there. So what I would recommend you guys do is sit next to him. And if you got any personal questions, just whisper, Chris, what does this mean to me? And I'm sure he'll be happy to answer free of charge. So, Chris, I'm glad you're here. So let's go ahead and dive in. I want to introduce our esteemed panel, and I'm going to start over here in the far corner with Maggie Vining, and Maggie's counsels on high net worth individuals, businesses, and families in trust and estate matters. She is with the law firm Davis, Wright, Tremaine, as is Pat, and DWT, as we call it. They are a preeminent law firm in the Portland area, but also have offices all over the country, from New York to Washington, D.C., I think Anchorage, Seattle, San Francisco, L.A., and then Shanghai. So this is a very, very strong, preeminent law firm, and we are good friends with our friends at Davis, Wright, Tremaine, and have a number of clients in common as well. Maggie also was an undergrad from Yale, and got her law degree from the University of Virginia. So welcome, Maggie. And Pat Green is a partner at DWT. He's recognized nationally for his expertise in wealth transfer strategies, estate planning. Pat is homegrown and is a duck through and through, both as an undergrad as well as a law degree. So Pat Green, my Oregon friend, welcome.
Oh, wait, I'm from Philadelphia, so.
Oh, okay. Way to go.
Yeah.
I was happy, very,
Yes.
very happy. Any New England fans in here? Oh, sorry, Phil. Oh, okay. You guys, you've had your share. Okay, and then my closest trio here, I'll start with Trent, since he is right on my left. Trent Bakel is a senior tax manager. He works both with corporate and individuals. He's part of our real estate team as well. He's been with Perkins over 10 years now. And Trent is a proud Michigan graduate and has a master's in accounting from Washington State University. Welcome, Trent. And wait, who was whistling for, was that Wazoo? Okay, all right. And next to Trent is Amy Kutsky. Amy is a shareholder on our legacy planning team. She joined Perkins 3 years ago, came up from California to enjoy our beautiful sunny weather. And Amy has an accounting degree from San Jose State University. And last but not least, I actually wrote notes, but I don't have to look at my notes when it comes to Eric. So last but not least, Eric Hormel in the corner. Eric heads up our legacy planning team, one of the strongest in the city. Eric is a homegrown Oregon guy and actually a second-generation accountant. His dad was, not third though, just second? All right. And I had some wild comment about third generation, but it's not going to be, I don't think, at this point. He's married, but no children. Anyway, thanks, Eric. I'll keep moving. Eric's been with Perkins for 21 years, and he's a proud graduate from Santa Clara University. So how about a hand for the panel before we start? Give them a little inspiration. So these guys have been poring over this information for months, weeks, waiting, anticipating. How thick was the document?
It's 500 pages.
Yeah, 500 easy read, single space pages with a few scratch marks on them. So we're going to dive in, and I think, Amy, are you going to take the ball first and get things rolling? Yes. Okay. I guess I'll keep this, and I'll roam. So if you have a question, raise your hand, and I'll come grab you.
Hi, welcome. We are going to start off with just a few little tidbits on the individual side just to get you ready for Trent's big business update. So a few things on individual tax reform. We're in a time now where we're just at lower income rates. That was one of the biggest things that came out for individuals. But these are set to sunset after 2025. So nothing in this bill is permanent.
Yeah, and I think one of the things we're going to talk about today and what we want to leave you with are takeaways. One of the big takeaways is primarily this is a corporate tax bill. We're going to focus on some of the individual provisions first, but we basically, Trent, we had about $1.5 trillion to spend. When I say we, Congress, and those are our dollars. So the first thing they did was on the C corporations, which Trent's going to cover in a little bit. They tried to drop that rate to 20%. They ended up at 21. Don't want to steal your thunder, Trent. So that used a certain amount of that $1.5 trillion. Everything else kind of filled in the rest. So Pat and Maggie are going to talk about some of the gift and estate parts. We're talking about the individual pieces, but everything we're talking about today will sunset. So in 7 years, and that's 2 election cycles from now, we're going to have a complete sunset of all these bills we're talking about. However, the corporate bills are permanent. Bill changes.
So all of these that we're talking about today are effective January 1st of 2018, so it won't affect your tax returns from last year, but going into planning this year, we need to be aware of these. They did bring the tax bracket, the top tax bracket is now 37%, so some people are getting a break there, and they've also widened the bracket, so you may have been in the middle of one, you may end up in a lower bracket this year. Personal exemptions, though, have been eliminated, so this whole bill is a lot of give and take, where they give you a little and they take a lot away. And the child tax credit was increased from $1,000 to $2,000, and they've refunded a little bit more of that.
And I would say that the ability for a lot of our clients in the prior years was they really couldn't benefit from this child credit. It was $1,000, but the ability to deduct that started to get phased out at $100,000. Well, now they've doubled it. It's up to $2,000, but that phase out, I think, starts about $400,000.
Yes.
So there's going to be a lot more taxpayers actually able to benefit from this child tax credit.
We used to joke that if you could afford a child, you can't take the child tax credit, and so now they've made it a little bit more even, so you might be able to benefit for that now. The medical expenses, just a quick one, it had gone up to 10%. We're back to 7.5%, at least for 2 years. State and local taxes, this is a huge one, especially in Oregon when we pay such high state tax. All of your state and local taxes are capped at $10,000 per person or per tax return. The mortgage interest is now limited on any new loans to $750,000 worth of debt. If you had an old mortgage that's up to $1 million, that will be grandfathered in. It's any new loans that happened after December 15th of 2017.
Right, and another takeaway from this is kind of Dave touched on a little bit. This bill is about 5 weeks old. there's still a lot we don't know, meaning that there needs to be clarification from the IRS. Trent's going to cover that in a little bit, some very important sections. But for instance, on this $1 million mortgage, I recently had a client call me and said, Eric, I've got $1 million mortgage. I got it back in, say, 5-6 years ago, but it's at 4%. I'm thinking about refinancing. So I want to take that $1 million mortgage and refinance it from maybe 4.5% down to 3%. But if I refinance, do I lose the ability to deduct the full $1 million and I only get to deduct $750,000? I think the answer to that one is we think you are able to deduct the full $1 million, but there's no clarification from the IRS yet. So that's just one example of the things we're trying to work through, and that the IRS is supposed to be providing us extra guidance on that over the next several months.
They haven't set any deadlines for themselves yet, though. So in the future, they may have some guidance.
Right. Yeah. And then on the state and local tax provision, as Amy said, very powerful for us. So that's any state income tax, any personal property taxes we pay. It's all limited to $10,000. But you can deduct any any property taxes on business property. So if you have rental properties, you can continue to deduct that. If you have investment properties, you can continue to deduct that as well. Not only the property taxes on it, but the investment interest as well.
Correct. So these are solely limited to anything you would have on Schedule A, but Schedule E's work same as they always have on those. A couple other changes on itemized deductions. Charitable contributions used to be limited to 50% of your adjusted gross income. That's gone up to 60%. So they've helped out a little bit there. They've also taken away a little and said if you buy any athletic seating rights, they're no longer even 80% deductible as charitable. 2% adjusted gross income deductions have been suspended. So that's a lot of the investment fees, tax prep fees, all the good stuff that happened down there. However, if you do have any of those expenses that Eric had mentioned, like your tax prep fees that may be related to your rental properties or Schedule C, those would still be able to be deducted. It's just the Schedule A deductions.
You're going too fast.
Oh, sorry.
You need to absorb it all?
Okay, thank you. There was a phase out in previous years of your itemized deductions. If your income got to a certain level, that has been eliminated. And the standard deduction has increased to $24,000 for married filing joint and $12,000 for single.
All right, so now we're going to walk you through an example, but what have we talked about? We've talked about, number one, they're lowering the rates, but they're really doing away with a lot of the itemized deductions. So they said, hey, you could be limited definitely on your state and local taxes and your property taxes. You could be limited on your mortgage interest now. All of your investment fees, all of your tax prep fees, those are eliminated. So we're going from a system where potentially we're going to have higher taxable income, but hopefully lower tax. So we're going to walk through an example that kind of illustrates this. So this is a case study for a taxpayer, married filing joint. They make about $250,000 a year. They're renting their home, but they are paying about $20,000 a year in state income tax. So when we walk through this illustration, we want to show you what happens in 2017 and then what actually happens in 2018.
This one doesn't have animation on it. So
That's all right. We can go to the next slide. Okay. So we're going to give away the punchline. So in this case, we have the taxpayers in 2017. They're making $250,000 a year. In 2017, they were able to claim their two exemptions of $4,000 each. So that's $8,000. Additionally, they're charitably inclined. So they give $13,000 a year to charity. They're able to deduct that. And then I think they have $20,000 in tax they're paying to the state of Oregon. So we reduce their taxable income, the $250,000, by the exemptions and their itemized deductions, and they end up with taxable income of about $209,000. Now on that $209,000, they have federal tax of $45,000. So that's 2017. Well, what happens in 2018? In 2018, we move forward, we lose those exemptions. They're gone. Also, we're still fully able to receive that benefit for the charitable contributions, but the $20,000 we're paying to the state of Oregon, it's capped. We only get a $10,000 benefit. So that puts our total itemized deductions at $23,000. Well, what did Amy just say at the very last part of that slide? She said, your standard deductions now, it went from 12 to 24. It roughly doubled. So what does that mean for this taxpayer? For this taxpayer that's historically, for many, many, many years, always taking their itemized deductions, they're taking the standard deduction for the first time. And I can't tell you how many taxpayers I've sat down with that are now taking the standard deduction. These folks that have been really good savers, they paid off that mortgage, you know, they're likely going to be taking the standard deduction now. Okay, so we start with our $250,000 of income. We get the $24,000 standard deduction. Taxable income $226,000. But look at that. Our taxable income's higher, but because of the rates, we're actually going to pay a little bit less. Now, another reason we put this example in is there's a lot of concern out there because something should jump out at you here. And what should jump out at you is if this taxpayer gave $1 to charity or they gave $13,000 to charity in 2018, their tax liability is the same. They receive no benefit from their charitable contributions. So to give some context, in 2017 and prior years, roughly 30% of all taxpayers took the itemized deductions. It's been projected that as a result of this tax bill, between 5 and 10% will be able to take itemized deductions. What's that mean? Only 5 to 10% of all taxpayers will actually benefit tax-wise from making charitable contributions. So this is really going to change the way we think about tax planning. So what we decided to do was there's a strategy called bunching where we take our charitable contributions. So instead of giving $13,000, say in 2018 and $13,000 in 2019, what if we gave 26 all in one year and gave 0 the next year? Well, if we do that, we end up saving, I think, about $3,000 to $4,000 a year. So I would have never thought this way prior to, December 23rd, 2017. But the way we're thinking about how this bill impacts our taxpayers, it's quite evolving. Does this math make sense? Does anybody have any questions before we move away from this slide, kind of on the mechanics of the bill so far? Okay.
Eric, is it too much in the weeds to address what you're hearing or from charitable organizations now? What is the common thinking in that regard? Number one, and then number two is there some advice in terms of how people, are you going to address this, Pat and Maggie, I'm not sure, in terms of that advice for people if they are charitably inclined and think about this bundling and bunching and all that structurally?
Yeah.
Is that too deep?
Well, yeah, I don't want to use up too much time. Okay. But there's a vehicle out there called a donor advised fund. I don't know if folks have heard about that. But basically what it allows you to do is kind of bunch your charitable contributions. So let's say that you knew that you really wanted to take 4 to 5 years worth of charitable contributions and give them all in 1 year so you'd get this tax benefit for it. But maybe you didn't want to give all that money to the charities right away, or maybe you didn't even know which charities there were. A donor advised fund allows you to do that. So you can go to a Fidelity, or you can go to Charles Schwab, or you can just go down to our friends at the Oregon Community Foundation and set up this donor advised fund. They're really fairly inexpensive to set up. It's not exotic at tax planning. But basically it allows you to say, put $20,000 away this year. You can do it with appreciated stock. You can do it with cash, just like any other charitable contribution. You get the deduction this year. But you're not compelled to have that fund give any money to the charities you'd like until future years. So you fund this donor advised fund, and then over time, you just simply call them up and say, I'd like to make a distribution to Guide Dogs for the Blind or Salvation Army. So it's a vehicle that I think is going to get much more popular. Much more popular. And I think that there was a statistic that I saw that there was something like 60% more giving to the donor advised funds in 2017 than any other year. So they're beginning to become much more prevalent. The other thing I'd say is if anybody's taking their required minimum distributions from their IRAs, if they're retired, I think we're going to see more people taking that IRA distribution and giving it directly to charity. If you do that, you don't report the income and it doesn't go on your Schedule A. I think that's getting in a little of the weeds. But it's the way we're thinking about these changes is definitely changing.
From the boards that I've been on to with the nonprofits, they're hoping that people give out of their hearts rather than tax stuff. They said 2018 will be the year of truth to see what they're doing.
Got a
Yes.
question?
Yes, in that example, what's the $8,100 exemption that they had in 17?
Yeah, so in 2017 and all prior years, you were just given a deduct or an exemption deduction of $4,050 per person.
Okay.
So it's just an additional deduction on top of what would be the standard or other itemized deductions.
Eric,
Yes.
just clarification. So if you did want to do itemized and you did charitable contributions, you could choose not to take the standard deductions?
Yeah, you always would want to take, yeah. So Sally's question was, so if you gave to charity, could you choose to take the itemized deduction? Well, you'd always want to get whatever's higher. So you have the option. So you would never want to say, I'd rather take the itemized deduction than the standard if it's less.
Right.
So what you'd want to do is kind of bulk these charitable contributions into 1 year so you get over that $24,000 hurdle.
So Eric, you're saying like in this example where they're giving 13, maybe they would put in 26 at the end of 1 year, get that deduction which is higher than the 24,000, and then they would say, okay, maybe over the next 2 years, I'll give 13 this following year and then 13 the next year, or you could double down the next.
Right, and if you do that strategy, where in this case, let's say, instead of giving $13,000 a year in 2018 and another 13 in 2019, if you gave all 26 in 2018, you end up saving $3,300 between the 2 years.
Okay, anybody have any other questions on this part? Okay. Gonna move on to some other provisions. So we have the Section 529 plan that now allows for you to take out money for elementary and high school tuition up to $10,000 annually. There's still some speculation on whether or not Oregon will conform to this, so they're hoping to have some sort of resolution in the next few weeks on that. The alimony deduction and income pickup is on any, I don't know if in previous years, if you paid alimony, you were able to deduct it. If you received alimony, you had to pick it up as income. Any new agreements that are executed after 2018, that's no longer the case. Alternative minimum tax is on its way out, but they have increased the exemption. They've also decreased some of the itemized deductions that affect AMT, so we don't think it's going to be as big of an issue going forward. You're still able to do Roth conversions, however, you're no longer able to recharacterize those, so that's a little, yes?
So the 529 plans,
Yes.
would that be part of the itemized deduction that doesn't make any sense until you clear $24,000?
No. So the itemized deductions do not take into account this 529 plan. In Oregon, you do get a credit for it, or a deduction for it in Oregon, but it does not affect your federal return.
Yeah, so
So what's the treatment federally for the 529s?
So traditionally, when you contributed to a 529 plan on the federal side, it was a non-event. So let's say in 2005, you put $10,000 into a 529 plan for your child. And so the people that don't know, the 529 plan's a vehicle to allow for college savings. That's what it was prior to 2018. So on the federal side, you put $10,000 into this account. It was invested when, let's say your child was very young. They're 18, they go to college. That $10,000 may have grown, hopefully from $10,000 to $50,000. That $40,000 of appreciation, they pull it out, they use that for college tuition. You pay no tax on it. So that's the advantage of the 529 plan. You don't get a deduction when it goes in, but you don't pay the tax on the appreciation when it comes out. The change that came through is now on the federal side, they're saying you don't have to wait for your kids to go to college to access these funds and these appreciated assets. You can use it for K through 12 education.
Correct.
What our concern is, or what we're hearing from the Oregon legislature is, pursuant to Oregon's constitution, you cannot use funds, state funds, to support religious organizations. So meaning if your kids go to Central Catholic or to OES or some other school, there's a lot of question about if Oregon will conform to these rules. We don't know the answer right now. So it's another example of one of those things, literally. So, and to also give context, the last major tax reform bill occurred in 1986. And I don't know, I wasn't really practicing then, Pat. I'm looking at you. But I think it took about a year and a half of negotiation to get this thing done. They got this one done in 4.5 weeks. And so there's so much that we don't know. And I don't think the folks in Congress actually knew what they signed off on. But we're learning. We're learning about that now.
Okay. We're going to move on a little bit to some other individual things that are flowing through the business income. So we have net operating losses now that are carried forward, cannot be carried back. So previously you were able to carry them back 2 years, carry them forward 20 years. Now they're only carried forward indefinitely, but they're limited to 80% of your income. And later on, Trent will go into that a little bit more. Also, business losses are limited to $500,000 on a married filing joint return and $250,000 for single, and we'll go through an example on one of those as well. Any of your excess losses are added to your NOL carry forward, and so all of these limits are at the partner level, not at the partnership level. So. We have a quick example here. The husband in this instance is a sole proprietor. The wife is an employee, and they have 2 grown children. The wife has $400,000 of income. We have $25,000 of interest and dividends, have some short-term capital gains, and we have a $600,000 Schedule C loss. So in 2017, there would be 0 income. We're able to use all $600,000 of that loss to offset the remainder of the income. So we have 0 taxable income. In 2018, our loss is limited to $500,000, so we still have $100,000 worth of income. So we start with that same line, 2017, 0 income. We have exemptions still. We still have itemized deductions. So we actually have negative taxable income, and 0 tax would be due in 2017. Now in 2018, we still have this $100,000. No personal exemptions. Our itemized deductions have gone down because we've lost our state tax deduction and whatnot. So now we have $73,000 of taxable income, and we end up paying $9,000, just under $9,000 on that same income. Now the other $100,000 of that loss that we weren't able to use, we carry forward to 2019 as an NOL. But these are big things to look for. If somebody has a bad year, they could end up with taxable income where in previous years they never have. So I'm going to turn it over to Trent. He's going to talk more business.
Yeah, the NOLs and the business loss limitations, I mean, that's another example, like Eric was talking about, the give and the take. So this is another way that they are paying for some of those corporate tax cuts is, instead of being able to use all those losses and not pay any tax or even carry it back and get some of that refund, now, without planning and knowing about this, you're going to have some surprises when we've got all these losses potentially and having to pay tax on it. Which moves into this qualified business deduction. So are people in the room familiar with what this is? This is this quote unquote pass-through business deduction, but it actually impacts more than just pass-through businesses. So it's more than just S corps. It's more than partnerships. It's also sole proprietors, Schedule Cs. It's also if income is passed through to beneficiaries of trust, if it's this qualified business income. It's Schedule E rentals. It's basically anything that you're not paying C corporate tax on that meets the definition that we'll talk about is potentially eligible for a deduction. And so we may not have to pay tax on 100% of this income. It's applied to adjusted gross income. And a big one here, no material participation required, so that you could be a passive investor and still potentially have benefit of this provision. So what is it? So qualified business income is basically all income except specified service businesses. Well, what's that? This is This is probably one of the biggest areas. You know, the IRS actually released a bulletin last week of saying, okay, we've been inundated with requests from taxpayers and their advisors about having to explain these rules because, you know, not sticking up for the IRS, but they weren't the ones that wrote them. It was Congress wrote them. Now they have to execute them. A lot of this stuff we're still sifting through. We've got a lot of questions. This is number one on their priority list because this has the most questions that we've come across, that we've been getting, that we just are not sure how it's going to apply. So specified service businesses, they listed a number of them. So health, accountants, attorneys, financial services, they're all listed. Architects and engineers were actually carved out, and so they do qualify. They're not considered a specified service business, but then they also kind of left this very nice quote at the end, relies on the reputation or skill of the employees or owners. Well, I'll give you $1 if you can tell me what that means. You know, that's a very gray area. We need to know a lot more on how they intend to apply this. But taking a step back for a second, when we're talking about this, if our taxable income, because remember, this is individual tax issue when we're paying tax on that business income. If our taxable income is less than $315,000, all of this other nonsense and spider webs and complexity that I'm talking about, how we have to calculate this, doesn't matter. We automatically get it. So we could be an accountant that taxable income's $314,000. Any qualified business income that's relating to those accountant fees will qualify. If we're over the phase out of $415,000, now I wouldn't. So that's one thing to keep in mind. If we're under $315,000, we're going to get it. If we're above that, then we need to start knowing what some of the rules are a little more. It also does exclude investment income. So if we get that interest income or dividends or some kind of capital gains that come out of our businesses, that's not going to be eligible. Qualified REIT dividends are, publicly traded partnerships are eligible. So again, a nice benefit for passive investors.
Right, and just to give context to that, so what Trent's saying is, hey, if your taxable income's under $315,000, every source of income you're going to have is going to qualify for this 20% reduction. If you're over the $315,000, pretty much everybody else will qualify too, unless you're in a service industry. And a certain service industry, so Trent went through, they actually laid out accountants, attorneys, medical, finance. And literally, so how big a chunk of the U.S. economy is the service business. So I've got clients that are in the advertising, marketing, consulting, other areas. And it literally says in the bill, if your job or if this service is based on the reputation of its employees or its owner, you don't qualify. So does that just strip out 70% of the U.S. economy is not going to benefit from this bill? We don't know. And it's making tax planning for our first quarter, which is just a few months away when this is going to apply. We don't know what the heck we're doing. That's another takeaway. We don't exactly know everything, if you haven't figured that out yet. So, but we're in very interesting times. And so this is the IRS's number one issue, is to get this definition of who isn't going to benefit from this. Because most American businesses are these things we listed: sole proprietors, LLCs, S corps. This is the heart of the U.S. economy.
Yeah. So okay, we're over the 415 limitation, so we need to know our rules. What are our rules? Well, the deduction is up to 20%, so we may only have to pay tax on 80% of that income. But we've got some layers of analysis to find out if we qualify for the full 20%. So the first one is we look at that compared to 50% of wages paid. So the code section for this is actually 199 capital A. Domestic production activity deduction, I'm not sure how many in the room are familiar with that. That's gone. That was old 199. It's thought to be basically a replacement, that we took one away. We're going to give you something else as a replacement. It's actually broader. It's going to apply more. But a big thing there was that for domestic production activity deduction was you were making something in the U.S. and you were employing people in the U.S. So it's got that same spirit. So we're looking at that 20% of that income or 50% of wages, or, and this is the one that they threw in right at the end for anyone that was following tax reform, this is the Corker rule, where, okay, who's going to benefit here? 25% of wages or 2.5% of adjusted basis of depreciable property. This is the real estate rule, basically. I work a lot with real estate. The typical structure is not that there's employees within every real estate entity. And so we weren't going to qualify for those businesses. Now we will. Now, whether we hit that full 20% or not, it's going to be facts and circumstances because it's based upon the unadjusted basis. So if we've got old property that we've had for a number of years, our basis is probably low. If we've had 1031 like-kind exchanges once or twice or 3 times, our basis is probably low. So we might not qualify for the full 20%, but it's better than nothing. Again, this does not apply if we're under the 315, and this deduction is going to be determined for each qualified trade or business activity. So this is another area, and Eric was somewhat alluding to it in his comment, that we need more guidance on is what's considered a trade or business activity. So, a common example might be veterinarian. So veterinarian service-based, not going to qualify, but there might also be selling pet food and pet supplies. Now he's selling something. That sure feels like it qualifies. Are we able to split that out? Is he or she going to have to, create a separate business for that? We don't think so, but it's something that we'll need more guidance on as, how do we allocate costs between these different trades or businesses? Are we able to do that to be able to get a benefit for some of our income producing activities?
Right, and here's another takeaway. If you haven't figured it out already, as Trent likes to say, this is the Accountant's Full Employment Act. So we're going to spend the next 7 years trying to figure this thing out, and then it's going to sunset. So it'll be very interesting.
Yeah, a few years ago, my mom was worried when Herman Cain was going to pass a flat tax, and she was just out a couple weeks ago. She didn't ask about job security anymore. So let's run through a quick example. So we've got an LLC business owner, makes $750,000 of income. Let's look at 17 compared to 18. So same income, same deduction items. So one thing that pops out right off the bat is self-employment tax. That didn't change. So this qualified business income deduction doesn't impact your self-employment taxes on the individual return for this income. But in 2017, so we get $65,000 for the DPAD. We've got our itemized deduction of state taxes, our taxable income, a little over $600,000. For total taxes of about $195. 2018, $750. We lose our DPAD, so we lose $65,000. We lose a bunch of itemized deductions, but we get a $143,000 qualified income deduction. Our taxable income now, even after we lost DPAD, even after we lost almost $50,000 of itemized deductions, our taxable income went down almost $30,000. So that's that domestic production activity deduction. So that was in place starting in 2004. It was a deduction for if you were making a tangible product or designing a tangible product. So that's what went away. This is the replacement. And so the combination of that deduction, so again, in taxable income is down $30,000, but we saved almost $20,000 in taxes because of those tax rate impact that Amy and Eric were talking about. And so you might think, well, 20% of 750 is 150. Why didn't we get a $150,000 deduction? So that's that last layer of analysis that we need to look at is it's limited also to 20% of taxable income. So we take our 750, we take our self-employment tax deduction, we take our allowable itemized, we end up with about 714 of taxable income. That's why we didn't get the full 150, but still very powerful there. Any questions on that? So moving on relatively quickly on some general tax reforms. So, Eric talked about how there's going to be a lot more individuals in the U.S. that are itemizing. There actually was also some simplification for small businesses, and they consider small businesses those with average gross receipts of $25 million. It's going to give them better access to using cash method. It's going to ease up some rules and restrictions on how they account for inventories. So that is definitely a good thing. Bonus depreciation, so our depreciation rules have been updated and we're going to 100% bonus depreciation. This actually goes back into 2017 a little bit, the last couple of months. And we've got this new and used properties. So for those of you that are unfamiliar with bonus depreciation, it's the idea that you buy a capital asset or a fixed asset for your business. If it was a new original use property, you're able to take, depending on the year, the last couple of years it's been 50% right off the top, then you depreciate the rest. We're going to have 5 years of being able to take 100% bonus depreciation. So this is going to be a nice deduction generator for our trades and businesses.
And Trent, that actually kicked in at the end of last year.
That
right?
kicked
so
in.
We've got 4 months of being able to take this additional depreciation that we're taking right now.
Right. So a question, we were talking about what's Oregon going to do for the 529 plan. What's Oregon going to do for any of this? So the rule in Oregon is that they're automatically connected to federal tax changes unless they proactively disconnect. So what we've been hearing is that they will disconnect from the qualified business deduction that I was talking about, because they had disconnected from the domestic production activity deduction earlier. We're not sure if they're going to disconnect from 100% bonus. The indications that we've heard is that they're not going to, but they're going to be meeting, I think, in a couple of weeks to hopefully finalize that so that we know, so that we can finalize and file our 2017 tax returns that may be able to benefit from this.
Right. So basically, we're in a holding period right now. We don't know. So the feds gave us this great deduction starting in 2017. We don't know if Oregon's going to do it, and we certainly don't know a lot of business owners here. You probably have activities in a lot of states. We don't know what the heck California is going to do.
Yeah.
Oh, I know. They will not connect.
Yeah. So the California historically has said, we don't care what the feds do. We're our own nation here. We're not going to follow your rules. So now we might have to keep a set of books for the feds, for Oregon, and then maybe California. So
Yeah.
there's extra layers of complexity.
Yep.
So if you can write off a whole combine for the Fed, are you only worried about your state tax that you can't write off if they're, or can they keep you from getting the Fed too?
No. So the question is, if we write off a combine or we write off an asset, can the state not allow us to write it off for federal purposes? And that's not the case. So what would happen is that we would have an add back to our income for Oregon if they disconnect. So if we paid $200,000 for an asset, we write it off for federal purposes, it's still eligible for 50% bonus, so we would have to add back $100,000 less whatever other depreciation we would get on that remaining basis. So it would be a state tax issue only. So keeping on the topic of deductions, so Section 179 expensing, so the limit increased to $1 million here. So this is a similar concept. We buy an asset and we just expense the entire thing. So we just got 100% bonus depreciation, so why would we care about Section 179? Well, Amy talked about the NOL rules and the business loss rules. There could be some planning involved there. With Section 179 expensing, the rules are you expense it to the extent of taxable income. If you've got more expense than taxable income, you carry that forward. So if we carry it forward, that carry forward's not going to be subject to that 80% NOL limitation, and so there could be some planning opportunities around that. Real property depreciation, just very briefly, you see the asterisk I have on the 15 years. So this is what is in the committee report, is that to the extent we're doing improvement to any interior of a non-residential building, we can deduct it over 15 years. 15 years means it's eligible for bonus depreciation. Go to the code section, it's not in there. This is one where they have it in a committee report. This is what we're going to do. Somebody forgot to put it in the margin on page 233, and so it didn't make it in there. We're expecting a technical correction to update it, since that was the intent, but it's not in there right now. So as we're talking to clients about planning around this, we have to throw that caveat that we're expecting them to do it, but until they do it, we can't plan on it. Quickly, like-kind exchanges. This has been a popular one in DC, is what they're going to do with like-kind exchanges for a number of years. On real property, they really didn't do much. So real property for real property exchanges are still allowed. You don't need to trade within the same asset class, but they did completely remove personal property like-kind exchanges. So we trade in our old piece of equipment or we trade in a car, now we've got a gain or loss recognition based upon that trade-in value that they gave us. So we could have gain on that front end of that trade-in, but what do we got? We have a 100% bonus for the next 5 years, so it shouldn't have a taxable impact at least until 2022. Very briefly as well, another hot topic that was in Washington, D.C. was the carried interest rule. So this is that hedge fund rule that has gotten a lot of press, where these hedge fund managers make a lot of money. They're only paying capital gains because they get that allocation of that. This is a partnership issue. They're not putting any money into the deal, but when they sell it and they make a lot of gain, they're not paying ordinary tax rates. So they actually had a pretty decent compromise here. So now they can still get that capital gains on those asset sales where they get those profit allocations, but there's a 3-year holding period requirement now instead of 1. So you just have to hold on to it a little bit longer to get that preferential tax treatment. I'm going to hit the interest expense limitation relatively quick, because this one can get very complex. We can talk a little bit more about it at the end or afterwards, but this is a new concept where in order to fully deduct your interest expense, you're going to be subject to a 30% limitation unless that amount is less than, 30% of taxable income before interest, before depreciation, before amortization expense. So if you're heavily leveraged and have a lot of interest expense, you may be subject. Luckily for a lot of businesses, it does not apply to that small business. So if you're under 25 million, we don't have to worry about it. It's for those larger businesses. And again, the D-pad has been eliminated. Not going to talk too much about R&D. It's still around. It's still permanent. Startups can still use it against AMT. We've got a capitalization requirement in a few years, but they didn't do much in the way of credits as part of tax reform. There's a lot of credits that expired at the end of 16. They're still gone unless they do something, but R&D is still around. A couple of miscellaneous expenses that impact a lot of businesses. So entertainment expenses are no longer deductible. They're non-deductible. So those Blazer tickets, those Timbers tickets, those greens fees for golf outings, those are non-deductibles, or fully non-deductible. Meals are now 50% deductible, so even the ones that are brought in for the convenience of the employer, those are no longer 100% deductible. Qualified transportation fringe expenses, so we're paying for our employees' parking downtown. That's non-deductible unless we include it in their compensation. They can still pay for it pre-tax if they have a Section 125 plan, but for the employer, question?
Yeah, so is this one of those ones you said is indefinite as far as the change in the tax code? Or is this sunsetted?
This is permanent. Yeah, so the individual provisions were the ones that were sunsetting, not the general business, with the exception of there are some sunsetting of the bonus depreciation. That's 100% through 2022, but corporate tax reform. So very quickly on this, there's as Eric said, this is what started it all. No sunset here, so this is permanent. I always use air quotes with permanent because it's only as permanent as the administration keeps it permanent. So there's no guarantee that there's not going to be a future administration that bumps this rate up, but we do have a 21% flat tax. It's going to apply to personal service corporations as well. So personal service corporations were paying a flat 35, now they're at a flat 21. All other corporations are paying a flat 21, so it's not graduated. So, if they're in that $0 to $50,000 taxable income, they're actually going to have a slight increase in their tax. But it's really a huge benefit as we get into higher taxable income. AMT is gone. Same NOL rules. Have a quick example to show the power of this. So we've got a manufacturing company. They've got $6.6 million of taxable income in 2017. You see they were eligible for the D-pad, so they got almost $600,000 deduction. They paid tax on $6 million. That turned out to be a little over 2 million. Same income in 2018. So it's C Corp, so they lose the D-pad, they don't get the qualified business deduction because that's an individual provision. So taxable income goes up, effectively $600,000. The power of that rate though, 21%. So income goes up by 600,000, tax goes down by over 600,000. So a lot of power in that corporate tax rate cut. You can see why there was all this bartering and trading off here and there to help pay for this.
And once again, as we just started talking about corporate, we're talking about C Corps.
Talking about C
So
Corps.
this is C corporations. The S corporations were the earlier slides where we talked about the 20%. And Trent's going to talk about that here in a sec too.
Yeah, so I think probably this is probably the number one question that I've gotten from a number of clients is, okay, they see that shiny 21% tax rate. Should I be a C Corp now? And the answer is, well, it depends. There's a lot of different factors. We shouldn't just be chasing after that 21% tax rate. I'm actually going to go to the next slide because we touch on a lot of these, what are the benefits? So we've got the lower tax rates, but we also have double taxation. We get to deduct our state taxes. We didn't touch upon the international tax implications of tax reform, but it could have an impact there. Could have an impact on how we're selling our business. So some opportunities, some things that I'm talking to my clients about is, what are you going to do with that money? Do you want to get that out? If so, you've got that double taxation. The double taxation puts us at, roughly 40%.
Right, and we went through that pretty quick. Does everybody know what double taxation is? So that would mean, if you're a C Corp and you have $1 million in earnings, we got to pay 21%. That would leave us roughly with $800,000. If the owners want that money, if they want that out, it comes out to them. It comes out in the form of a dividend, and then they pay tax again. So that's where, Trent, you're coming up with this 40% really effective rate.
Yep.
That if you want to pull all the money out, you're really at a 40% net rate.
Correct.
Can you do the math on that? Because I don't follow the math.
So when you take if you've got $1 million of taxable income, you pay 21%. So you've got $790,000 left over after you do that. If you pull all of that out and pay that in a dividend, the individual tax rate on the dividend is 20% because you'd be at the highest tax bracket. You'd have 3.8% net investment income tax. So by the time you pay 23.8% on that 790, effectively you've paid almost $400,000 of tax on that $1 million.
What about B Corp? Does that matter at all?
So the question is, what about B Corps? And B Corporation is, from a tax perspective, is treated as a C Corporation. So there's no difference here. They have the 21% tax rate. So coming back to opportunity, so if we're leaving that money inside the business, there could be some power because now we're only paying 21%. We may be paying lower state taxes on that. Help grow the business. If we fall under the small business stock exception and we sell in the future, we may be able to exclude some of our gain on that sale. Again, a foreign consideration, if we've got international, that we would be able to get a dividend received deduction for some of that income versus as an S Corp or an LLC with that foreign, that we're going to pay U.S. taxes when we bring that back. But some dangers. So, that effective tax rate. So if we're not leaving a lot of that money in the business, if we're pulling it out, this 29.6% rate, so what's that? That's if we're at the highest tax rate, which is 37%, but we qualify for the 20% qualified business income deduction. So we're only paying 37% on 80% of our income. That's our effective 29.6. So we just closed the gap considerably on the 21% C Corp. And that's if we're in the highest tax bracket. If our taxable income is lower than that, and we may be in a 33% tax bracket, now we've just continued to close that gap. 32.6% if we're passive, because again we're having to pay net investment income taxes on our income. a lot of that talk was if we're an S corp, well, we could always check the box, be a C corp as an LLC, but we lose a lot of the flexibility that we have as an LLC. So if we have different profit sharing arrangements, if we've got special allocations, if we've got a lot of the flexibility that LLCs and partnerships provide, we lose that by going to a C corporation. So how important is that to the business? So these are the considerations that I'm talking about. The big takeaway, and I think it's going to be the same when Pat and Maggie are talking is this is a great opportunity to ask those questions. Am I being efficient? Is there something else that I could be doing? The answer might be, let's stay the course, but it's a lot of these rules just got reset. So let's be asking these questions. I'm not going to touch on this too much other than the takeaway on this slide is if you're an S corp, we've got some extra time to get cash out of the C corp without paying that double taxation, that second layer of taxation, if we meet this criteria. With that, I'll pass it off to Pat and Maggie.
Thanks, Trent. I think this is on. Can you hear me okay? Okay. Estate planning. This is pretty much good news, but it's good news for a period of time. We've got until December 31, 2025, where this good news is available. Then, according to the law, we revert back to the 2017 tax. So when you look at this, you're looking at estate and gift tax and GST, that's generation skipping transfer tax. When you go one generation down and then you go 2 generations down, there's another level of tax. So when you look at this chart, if you were asking us what the exemptions were on the federal level in 2017, we would tell you for an individual it's about $5.5 million. For a married couple, you can see it's almost $11 million. Well, surprise, surprise, in the event that they tried to do away with the estate tax, they would have needed 60 votes. They couldn't get that. So what they compromised on was doubling down on the exemptions. And these are huge. $11 million for an individual, $22 million for a married couple. And again, that's today through the end of December of 2025. So really big numbers. And the inflationary aspect of this is that every year these will get slightly larger. They've changed the way they figure the inflation, but it's still good. These will get larger. The irony is, if you look at the way the tax law is, they kind of call it small, medium, and large. And a small estate today would be under the 11 million. That's a lot of wealth, actually. Somewhere between 11 and 22 million would be a medium estate, and somewhere over 22 million would be a large estate. I think the irony is those are all large numbers. It's moderate wealth even at the low level. So what does that mean? It means that less than 2,000 taxpayers in 2018 will probably pay estate tax. That number has been shrinking as these exemptions have gone up, and it's a very small number. But for anybody who has a taxable estate in business or real estate or stocks and bonds that's over this, there's still a tax rate of 40% over these exemptions. So it's a pretty serious deal. We will talk about the state. I'll let Maggie talk about that. But if you look at this, there is an opportunity, and we'll talk about some of the things you might do, because we view it as a window of planning. So Maggie, what do we got next?
Sure. So Pat just went over this. I think the biggest takeaway from this slide is that the opportunity to plan with this expanded exemption is here for 8 years, and it is done on December 31st, 2025. And we can say that, but anyone who was planning in 2012, we had a similar situation where we said, you got to get everything done by December 31st, because on January 1st of 2013, our exemption amounts are going to go way back down again. So everyone did a ton of planning. I know that we were all really, really busy doing that, and all of you were very busy doing that too, up to the last minute. And then things didn't change. They stayed the same. So I don't know. It's hard to predict what's going to happen in 2026. I think that although these numbers are very big, and even though now I think 0.5% of decedents every year actually have to file and pay an estate tax return, that's 0.5%. Historically, it was about 10%, and that remained steady up till, I think, 2010. Even though there are going to be very few people paying this estate tax, and although it seems like they're making quite a bit of money off of the estate tax, actually, as a part of the budget, it's a very, very small number. So I think it's not really a numbers issue. It's more of a social issue. How do we want to treat transfers
Maggie,
of
I might
wealth?
make one comment too.
Yeah.
I think a takeaway from this was we do have this window of opportunity at these high exemptions. But two things can happen, one of which is predictable under the law. They go away. They may not go away, as Maggie just said, but they actually may go away earlier. Depending on what Congress does between now and 2026, they can change this. This is not permanent. This is subject to whatever Congress does. So the takeaway is if you're going to use these bigger exemptions, this year and maybe next year are the ones to really look at.
Right, so don't wait. We want to talk a little bit about Oregon and Washington because these things haven't changed. In Oregon, the exemption is still only $1 million, $2 million for married couples. And then there's no portability. And what that means is under federal law, if if you're married and your spouse dies and they have that $11.2 million sort of coupon against the estate tax, then you can give that coupon to your surviving spouse. Under Oregon law, you can't give your $1 million coupon to your surviving spouse unless you set up a trust. So there's no portability in Oregon. And you can see the rates down there at the bottom.
And Maggie, could I
go
ask
ahead,
a
yeah.
question there?
Sure.
On that one? So could, I don't want to quiz you,
Yeah.
but how many states west of the Mississippi in the continental United States actually have an estate tax?
Well, Eric, I don't know the answer to that, but there aren't that many that actually
think you're right.
have the estate tax. The East Coast still has the estate tax, and there's a couple of states you can imagine that would still have, in the middle of the country, that would still have it. But California does not have an estate tax. Nevada doesn't have an estate tax. I don't think Idaho has an estate tax. Arizona doesn't have the estate tax. I'm just thinking about places where clients sometimes move to after they leave Oregon. Most of those states no longer have an estate tax. The biggest one is California.
And that's one interesting thing I've seen over the past few years, that California did away with their estate tax. So I deal with a lot of folks that have vacation homes in Arizona or California. And believe it or not, as they're getting older, they're changing their residency to California because California doesn't have an estate tax, and Oregon's kicks in, what did you say, Maggie, $1 million?
$1 million, right? And it's not indexed for inflation. And the thing is, for Oregon, unlike for the federal government, those estate tax dollars actually are a big part of the budget, so we don't see that going away anytime soon. And also, we don't think they're going to be working on portability either, because as soon as you bring up the estate tax, you can't really work on it without getting really involved with people that want to do away with it completely, people who don't want to do away with it, and nobody wants to talk about, let's make it easier for people who have $2 million to not have to do a lot of expensive estate planning.
Question.
Yeah.
Quickly said, unless you have a trust.
Right, so
Really quick.
yeah, well, we can go, I've got a diagram coming up in a few slides, but the one way, sort of classic estate planning that was done, like, my parents did it, when the first spouse dies, you would have a trust that would put the exemption amount into that trust, and it would, so say that, and it was $600,000, that was a federal exemption amount, maybe that was also the state exemption amount, $600,000 would go into that trust for the benefit of the surviving spouse, and that wouldn't be taxed at the second death. It would, however, have the basis would equal the fair market value at the death of the first spouse. So although you didn't have an estate tax, you might have an income tax if you sell the assets in that trust. And back then it was no question of which is better, right? Because the estate tax was very big. It was 55%. It hit at $600,000. And so that was always going to be higher than income tax. Now, because most people are not affected by the federal estate tax, they're only affected by the state estate tax.
16% versus 55.
So we're not as concerned with saving on estate taxes when you only have a state estate tax to worry about, because you might want that
stepped up basis on the second debt.
And actually, Maggie and Pat,
Yeah.
could you guys talk about that? You know, I know one of the things that was kind of people were hearing about, if they raised the estate tax exemption or they got rid of the exemption, you'd get rid of the stepped up basis. Can you just maybe tell the folks what stepped up basis kind of means and if it still exists in our current environment?
Well, I'll take that.
Yeah.
If you bought a piece of property for $100,000 and it's now worth $400,000, and you sell it, you'll have tax on $400,000 less $100,000, just in general rule. If you die with that $400,000 piece of property, you get a brand new cost basis of $400,000, fair market value at date of death or alternative valuation date 6 months afterwards. So that new cost basis, the survivor or the heirs can turn around and sell it for $400,000, and since the basis is $400,000, they have no income tax. And so realistically, basis is important, and on the step up in basis, now we're looking at saving income taxes, and if you didn't have, if you only had an estate tax at 10% or 16% versus, say, combined federal state 50%, and your income tax is maybe 20% on capital gain, you probably would look at this and say, well, I don't have a federal tax. I'm below 22 million, so that goes away, that 40%. I'm now worried more about the income tax, maybe combined federal state of 27, 28%. So getting basis step up is important. And Maggie was saying, if you put that $1 million aside at the first death, yes, you've saved maybe 16% state tax on it, estate tax. But if it's at $100,000 and it goes to $400,000 and you sell it, if you don't get a step up on basis when you sell it, you have to pay tax on that $300,000 at maybe 30% combined federal state. So that's a worse tax. So we're just now comparing income tax and estate tax, which will be worse, what will be more likely to sell, and that I think that's the challenge, is kind of looking at those two rates, those two systems.
And I think conceptually the idea was, behind that was, you pay one or the other, right? You either pay an income tax or you pay an estate tax. And so you trade off. So say, okay, I'm going to pay an estate tax, but then my benefit is I get a stepped up basis. So if we did go to a system where there was no stepped up basis because there was no estate tax, I could tell you the first thing I can think of is like, what a record keeping nightmare. I mean, Pat and I have worked with clients where maybe they thought they owned something, but actually they didn't. They gave it away years ago. And then just trying to figure, and then like the family wants to sell whatever that thing is. In this case, I think it was real estate, just trying to figure out what is the basis of that real estate. I mean, they had done repairs, they'd put, it was a record-keeping nightmare. And so in some ways, I mean, that stepped-up basis is really great because how many of you know what your parents have been doing? A lot of sins and bad record-keeping. Where that stuff is. So there has always been a trade-off between the estate tax
and it's really
tax.
powerful, like in Trent's world. So Trent's one of our real estate partners. So let's say you have a building, you paid $1 million for it 10 years or 30 years ago. It's fully depreciated. You die, it's worth $10 million on your estate tax return. You leave that to your kids. Your kids pay, when they inherit it, they get to start depreciating it over that $10 million all over again. So it's a really powerful tool. And that's still in existence with the new tax bill, the step up in basis.
That's true.
Yes, it is. Let's see, where are we here? Just really quickly, Washington estate tax, they've got a higher exemption. It is indexed for inflation. No portability up there either. And the rates are higher. So actually, if you run the numbers sometimes, Washington versus Oregon, you'll find that some of your clients will pay more in estate tax if they're Washington residents. But that probably doesn't make up for all the income taxes you'd pay in Oregon. So I want to go, where's that slide? Oh, here it is. So, right, you always hear that. Live in Washington, shop in Oregon. That's so sad. And die in California.
That's the best takeaway you've got here.
Shop in Oregon. Okay. So what should you do now? I think we kind of covered this already. We're running short on time and probably short on your patience. So basically think about income taxes, and I'm sure that your advisors are thinking about income taxes versus estate taxes all the time. And we've been doing that, I think, since 2012, really.
Right.
What to do now? So so really, you want to review your current plan, and it's the same thing. So maybe you were taxable before and you're not taxable now. Well, look at your plan and see if it still works. Do you want to worry about the estate tax or income tax, which is now going to be more important and more relevant to your estate? You want to add flexibility to your plan to anticipate future changes. So now we're always thinking that if things are going to keep changing, we want to make sure that we can create a plan for our clients that's going to take into account higher income tax rates, lower income tax rates, higher estate tax, no estate tax. So you want to make sure that your plan is really flexible. And if you did your plan way back in the 1990s or even the early 2000s or like the 1980s, it's probably not you guys, maybe your parents, you really want to go back and look at it again because it's definitely not, I don't think it would work today.
And I would just interject that, people spend a lot of money doing estate planning, and then they change the law like this. One of the questions I get a lot is, do I have to redo that whole thing again? Well, if you've got this flexibility built in, where you can make elections post-death and decide how much goes into these trusts, like the $1 million trust or the $11 million trust, then you can actually make those decisions after the fact. You don't have to change all of your documents. But it really does require that you look at it and see how flexible your document is.
So you want to review your current estate plan and maybe revise it. And then secondly, if you are still taxable or you might be taxable if the rates go back down, then you want to make gifts. You want to think about how to do that. So you want to repeat what you did in 2012 if you did something in 2012. And what a lot of the national speakers are saying is this is just 2012 on steroids. Mm-hmm. So you want to gift more assets. You want maybe do some sales. If you already did that in 2012, do it again. Reload, maybe with the same assets. You want to maybe consider giving down to the next, not the next generation below you, but for ones further down, like third and fourth generations. Okay, let's see. So we're talking about, okay, what could go wrong with your old plans? Here's an example of a married couple with $30 million, and this is second marriage. So if you have sort of a traditional plan where your exemption amount, right, that's that coupon, if it all goes to this special exemption trust, because that's what your trust says because it was done in 1985, well then in 2017, maybe that was okay because you would have a $5.5 million trust. Oh, and that trust also went to your children from the first marriage, right? And then everything else would go to your second spouse. Maybe that was okay, but then if you die in 2018, well, most of your exemption amount is going to go to your children from your first marriage, and there's not going to be a whole lot left for your spouse. So you really want to think about, and there's all different kinds of permutations on this, but this is like the most glaring one, is think about where you really want your estate to go. Did you want all of it to go to your children from your first marriage, or did you want to help support your wife until she's gone? Another example I could think of now is some charitable planning for our clients are tied to exemption amounts, right? And so how much do you want to go to charity? Maybe if now 11.2 million goes to your family and only 3.8 goes to charities, maybe you didn't want that. Maybe you want something more balanced. Maybe you want it 50-50 or some other kind of allocation. So really looking at your allocations and thinking, does it still make sense based on my old estate plan? And then income tax issues is what we just talked about with just thinking about, okay, where do we want the basis step up to be? Making sure that your plan is flexible so you can make different kinds of income tax and estate tax elections. And I'm not going to get too far in the weeds on this, but really thinking about whether or not your plan is flexible enough so that this trust on the left, the exemption trust, whether that really has to have the basis at the first death, or whether it can also be stepped up at the second death. What to gift? We're looking for good assets, so cash is great, right? Notes are good. High basis assets. We're again thinking about the income tax consequences of gifting, because if you give everything at death, it's got that stepped up basis. If you give anything during lifetime, you've got a carryover basis, so whoever receives your gift is going to have your basis. So if they're going to turn around and sell it, well, that could be a big income tax hit. So really thinking about what you're giving away. Okay, we already saw that. I want to just talk briefly about clawback concerns. So What that means is that some people are concerned that after 2025, that the IRS will say, well, now that the exemption is back down to $5 million, you have to give back that the extra $5 million that you used up. during
On the
this-
$11 million exemption.
Right, yeah, sorry about that. So yeah, so the exemption amount gets cut in half, back to 50%. Is the IRS going to say, okay, you have to bring all that back into your state when you die because that was only a temporary coupon you had and now you got to get it back? Does that make sense? What clawback means? Basically clawing back the gifts that you made during your lifetime back into your estate, so you have to pay an estate tax. That could be a real issue if, say, the estate is very illiquid and you don't have a way to pay for that extra estate tax. So you've given away your assets, then you have a big estate tax because it's really based on $11 million instead of $5 million, and you have no way to pay for it. I could see that as being an issue.
Yeah, Congress is supposed to, or IRS is supposed to come up with some regulations that would do away with that. That was the intent of Congress. But we just tell people that's a concern. It should be looked at.
Right. But, I'm sure they're going to get right on that after they figure out your problem. So,
If anything, they're swift.
Oh, yeah.
yeah, I don't think this is a priority. But it was also a concern back in 2012 and ended up not being an issue.
Right.
So we've run some numbers, and generally speaking, it's better to make the gifts even if there is a clawback. And the reason, and this is true for any state, if you die in a state where there's a state estate tax, it's going to be, and there's no state gift tax. So it's going to be beneficial to give away your money whether or not there's a clawback, because you're going to lower your overall combined state and federal estate tax. So if you can follow these numbers, you'll see that so you make a gift, and there's a clawback. Here you make a gift, and there's no clawback. So you can see that your federal estate tax changes, right? It's much bigger if there's a clawback than if there's no clawback. But your Oregon estate tax stays the same. So then if you come back down to the total estate tax, well, you're going to end up paying, let me go over here. So here is where you do no gift, right? So the clawback is irrelevant. You're paying a total combined tax of $14.5 million. That's still more than 13.9 if there was a clawback. So you're going to be ahead if you can make the gifts, even if there's a clawback.
Bottom line is Oregon has no gift tax, so anything you take out of your estate that is tax-free federally and it's been given away because it's in your gift tax exemption of $11 million, Oregon doesn't have a gift tax. The clawback would only occur at the federal level. It's forever gone. And clients asked me after we did all this planning in 2012, well, we put, say, $10 million, the $5 and the $5 million exemption away in a gift for children or spouses in some arrangement, and then that tax law never did go down. They said, well, should we have done that? And I said, well, $10 million times 16% is $1.6 million. That will never be paid to the state of Oregon on what we set aside, plus the growth on $10 million. So yes, that was a good thing to do.
So we have this one last slide that we can
Yeah,
very
it's just-
briefly look at.
Just really quickly, married couple, heavy real estate interest, $25 million. Fred and Megan both have additional assets of another $5 million, so this is that $30 million estate we said. They have 3 children. They're all adults, 2 minor children. Fred supports his 80-year-old mother, who's not in great health. Okay, I'll take the last one, because here, what are the planning ideas that come to mind, Maggie, is the question we ask ourselves, and clients like this would ask us. First of all, if Fred and Megan give the mother some low basis assets, they could give up to $22 million to mother. They won't do that amount, but let's say they gave $5 million of real estate that had a $1 million basis and it had $5 million of value. If mother receives that gift, and that's a gift that's not taxable because it's within their $11 million each exemption, they gave it free, and mother lives for a year. She has to live for a year. But if she lives for a year, she gets a step-up basis worth $5 million. That could actually come back to them in a trust, and they could start depreciating at $5 million. Or it could go down to the grandchildren, these three, or the two minor grandchildren in a trust, and they could depreciate at $5 million, and it could be done in a way that there was no estate tax at the mother's level, because that $5 million is under the Fed's level, even if it comes back in 2026. Might be an Oregon estate tax, but it could be done in a way that would be also exempt from that. So that's one of the thoughts that comes to mind with the 80-year-old mother. What about some of these other things you could do?
Okay, so some other things you can do is you could do a sale. You could sell some of your LLC units or some of your actual whole LLCs to your children, well, Megan and Fred's children. You'd have to, if you want to do it to a trust, you would seed that trust. You'd make a gift of 10% of the value that you were going to sell, and then you'd sell the rest into the trust. Parents get back a note, and so they haven't lost all the income. They still get some money coming back. Maybe they figure out, well, we don't really need too much. The stock market's doing okay. We're okay for retirement, and then they could forgive some of that note. So there's a variety of things that you could do. I think that the biggest takeaways from an estate planning perspective is really thinking about income and estate taxes. Number two, gift if you can, because the clawback really should not be a huge concern for you.
And you're locked in the exemption. There's no Oregon estate tax on that ever if you've given it away, because there's no Oregon gift tax. And so those are good strategies. They're what we've done in 2012. You may even have existing documents that all you do is just reload with value. Maybe they aren't redrafted. So I think there's a lot of opportunities, but the takeaway from this is they go away in 2025 at the end of the year. They could go away earlier if Congress is a different Congress and decides to do something else. So I think this year and next year are probably the best years to really revisit the estate planning and just see what you've got there as opportunities. Questions?
Any questions? Anybody? You guys aren't going to predict what's happening with Congress? The makeup?
I've been wrong so often, I won't do it again.
Okay. Any questions? So how about a hand for the panel, everybody? Eric on the left, Amy, Trent, Maggie, and Pat. And you guys will stay around for a few minutes, right, if we have one-on-one questions. Also a reminder, tomorrow, we're actually, the real estate team from Perkins is hosting a similar event tomorrow here at the same time, focused specifically on real estate. So if you have holdings, property, real estate funds, you're in development, consider that. Our real estate team will focus specifically on real estate tomorrow at 4 o'clock here, and you can sign up or just show up. We'll welcome you. Please stay for drinks and appetizers, and thank you all for coming. Did you learn a thing or two? Just one takeaway? Shake your head and go, I don't get any of this, and I need to talk to my professional advisors. That's probably the biggest takeaway, but good luck. Thank you all for coming. I really appreciate you being here.